Welcome back to the deep dive. Today we're really digging into a major player in the cloud space, a company that's pretty essential infrastructure-wise, Datadog.
That's right. We've got a stack of their recent materials, and our mission really is to unpack Datadog's Q3 2025 results. We want to understand how they're managing this growth, where the money's going, and critically, their strategic direction, especially with AI becoming so central.
Yeah, and that first number you see, the headline, it definitely grabs your attention. They announced, what, 28% year-over-year revenue growth? Hit $886 million for the quarter.
A strong number.
But we need to get behind that, figure out the how. Is this all new business, or is it about getting more from the customers they already have? That's the real question, I think.
Well, this deep dive, it really shows a company executing that classic land and expand playbook almost perfectly. Lots of companies are facing headwinds with IT spending, but Datadog seems to be cracking the code on increasing value from their existing base. And they're using that strength, that core platform, to push into new stuff. AI is obviously the big one right now.
All right, let's start with the basics then. The financials. The cash flow figures are just, wow.
Pretty staggering.
Operating cash flow, $251 million. Free cash flow, $214 million, just in Q3. But the one that really jumped out at me was their liquidity position. Cash equivalents, marketable securities, sitting at $4.1 billion as of September 30th. That's a huge number.
That $4.1 billion, it's more than just cash on the balance sheet. You have to see it as like strategic insulation. It's firepower.
Right.
When a company holds that much, they're basically signaling we're not sweating the day-to-day. They're holding that capital back for big moves.
So that begs the question, what are those big moves? Why not, return more to shareholders, buybacks, dividends? Is this all earmarked for R&D, or are they maybe keeping their powder dry for a big acquisition? The market's crowded.
It's probably a mix of things. But primarily, it's about that strategic insulation and funding growth. That much cash lets them tackle these high-risk, high-reward projects, like, say, building their own AI models, without worrying constantly about the next quarter's profits.
Okay.
And that connects directly to something really important we need to look at: the difference between their GAAP and their non-GAAP results.
Ah, yes, I saw this. And the difference is stark. So GAAP operating loss reported at $6 million. That's a negative 1% margin.
Right.
But the non-GAAP operating income jumps way up to $207 million. That's a 23% margin. That's a massive swing.
It is huge. And the driver, it's almost all down to how they pay their people. Stock-based compensation, SBC.
Okay.
That was $200.6 million for the quarter. Now, SBC isn't a cash expense,
Yeah.
right? So when you calculate non-GAAP, you largely pull that out. And that reveals the, let's say, underlying operational profitability.
So, okay, the strategy seems to be twofold then. First, they're sacrificing reported GAAP profits now for, faster growth and market share down the road.
Correct.
And second, they're funding that growth partly by paying their top engineers and developers heavily with stock. That conserves that $4.1 billion cash pile while they still push hard on innovation.
Exactly. It's a model you see a lot with these big, fast-growing cloud companies. They pay a premium for talent using equity, and the market, well, generally accepts it for now.
And management seems confident this will keep working.
Yeah, look at the guidance. For Q4 2025, they're projecting revenue between $912 million and $916 million. And for the full year, they're aiming for up to $3.39 billion. They clearly expect this momentum to continue.
Okay, so let's shift gears. Let's talk about the engine driving all this, the customers, specifically this land and expand idea. The total customer count grew, sure, up to about 32,000.
Steady growth there.
But the real action seems to be with the big spenders, right? The ones with annual recurring revenue, ARR, over $100,000.
That's exactly where you need to focus. That group, the big customers, grew 16% year over year. They now have 4,060 of them.
Okay, 4,060.
But here's the kicker, the really significant part. Those 4,060 customers, they account for a staggering 89% of Datadog's total ARR.
Wait, hang on, 89%. From just over 4,000 customers, that sounds concentrated. Doesn't that introduce a pretty big risk? I mean, if just a few of those major accounts decide to cut back or switch platforms.
That's absolutely the other side of the coin. It's the inherent risk in this kind of highly efficient but concentrated model. Retention is absolutely critical for them.
Makes sense.
But for now, at least, their ability to expand within those accounts is, well, it's remarkable. The numbers show about 75%, 3/4 of their revenue growth last quarter came from existing customers.
Wow.
Only about 25% came from signing up brand new customers.
All right.
That's why the metric everyone watches is their dollar-based net retention rate, or DBNRR.
And that DBNRR, the trailing 12-month number, they reported it at about 120%, which, as you noted, is up quite a bit from the mid-110s they were seeing a year ago.
Yeah, it's a significant jump.
Hitting 120%. That basically means your average existing customer from a year ago is spending 20% more with you today. That's powerful.
It really is. It shows the products are sticky, and their strategy of selling more services onto the platform is working. But you touched on the risk earlier, and it's worth noting the company acknowledges this in their own filings in the MD&A section.
Okay, what do they say?
They point out that customers, particularly those jumping into new AI workloads, can ramp up their usage really fast, which is great for Datadog.
Right.
But then those same customers might turn around and optimize their usage, basically, find ways to cut costs later on.
Ah, optimization, the double-edged sword of cloud consumption. So that pressure to optimize could directly threaten that 120% DDNRR figure.
Precisely.
And if that rate starts to drop, given that 75% of their growth depends on it, well, that becomes the #1 thing to watch for volatility, doesn't it?
Absolutely. So let's look at why customers are expanding. Let's talk
Yep.
product innovation. What's driving that increased usage?
Well, the whole strategy seems built around getting customers hooked on more and more products within their single unified platform, moving beyond just basic monitoring into security, logs, APM, the whole stack.
And the adoption numbers they shared, they really back that up. It shows the strategy is landing. Let's see, 54% of customers are now using 4 or more products. That's up from 49% a year ago.
Okay, more than half using at least 4.
Then you look at 6 or more products. That went from 26% of customers up to 31%.
Nice jump.
And maybe most tellingly, the percentage using 8 or more products went from 12% to 16%. Customers aren't just trying things out, they're embedding the platform deeper and deeper into their operations.
Yeah, that really suggests the integrated platform offers something, some value that stringing together a bunch of separate tools just can't match.
Exactly.
So where's the R&D focus? Where is all that engineering talent being pointed? AI seems to be front and center.
Oh, absolutely. The CEO made a point of highlighting their recent AI announcements. It's not just one thing. It's like a full stack approach. They've got specific AI observability and security products now.
Right.
And they've also developed internal tools, like something called Bits AI agents. These are targeted at specific roles, SREs, developers, security teams, to help them do their jobs faster, presumably.
Nice reliability engineers, right? The folks who have to fix things when they break in production. AI assistance there could be huge.
Mission critical, potentially, yeah.
And I saw they announced their own time series foundation model. TOTO, they called it. That sounds interesting. In observability, you're dealing with constant streams of data, right? Metrics, logs, traces, all tied to time.
Exactly.
So why build your own foundation model for that? Why not just use a general-purpose LLM?
That's a great question.
Yep.
It really comes down to competitive differentiation and handling that very specific high-velocity data type.
Yep.
Observability data is time series data. Having a foundation model trained specifically on that kind of data, billions or trillions of data points tied to time, lets them build much more specialized features. Think predictive analytics, super accurate anomaly detection, smarter automation, things that a general LLM might struggle with or be slower at. 2OTO is basically their specialized AI brain for observability data. It's unique IP.
Got it. Kind of future-proofing their AI capabilities on their own turf.
That's a good way to put it. And beyond the AI stuff, they also hit a big milestone. Over 1,000 integrations available on the platform now.
Wow, 1,000.
Plus, they're expanding support for other clouds, specifically Oracle Cloud Infrastructure, OCI, adding things like GPU monitoring there, cost management tools, even Cloud SIEM capabilities.
Cloud SIEM, that's the security information and event management piece, right? Helping analyze security logs and alerts.
Exactly. Pulling security data together from across the cloud environment. And speaking of security in regulated areas, they're also making a big push into government work.
Ah, the GovRamp mention.
Yeah, Datadog for Government is now listed as in process for GovRamp high authorization.
Yeah.
Getting that high authorization, it's a tough security bar to clear, but if they do,
It unlocks a huge market, right? Sensitive government contracts, those tend to be pretty large and sticky.
very sticky. High value, long-term potential there.
Okay, so all this innovation, the AI work, the OCI support, chasing government deals, none of that comes cheap. It needs serious investment.
And you see that reflected directly in their R&D spending. Q3 R&D was up 38% year over year.
38%.
And get this, that spending represented 45% of their Q3 revenue.
Whoa, 45% of revenue going back into R&D. That is
Impressive.
for us.
Profoundly aggressive. It tells you exactly where their priorities lie. They are pouring resources into winning the future product leadership, market share, especially in AI, even if it means lower operating margins in the short term. That $4.1 billion cash pile we talked about, that's the fuel.
Okay, so let's try to wrap this up. What should you, the listener, take away from all this? We've seen Datadog showing really strong financial health, fueled by that clever stock-based comp strategy that preserves cash.
Right.
They've got this incredibly effective land and expand model working, with existing customers driving most of the growth, shown by that 120% retention rate. And they're betting big, really big, on AI integration and expanding their platform's reach.
The execution so far looks, well, pretty flawless. But as we discussed, the future stability really hangs on a couple of key things. Can they keep that 120% DBNR going? And will their big customers keep increasing their usage at this pace?
Which brings us to that final thought for you to chew on, tying back to those risks they mentioned in their filings.
The macroeconomic uncertainty, geopolitical issues, things that could make businesses tighten their belts on IT spending.
Right.
So here's the question to consider. Given the Datadog's model relies so heavily on high usage from its biggest customers, remember those 4,000 driving 89% of revenue, what happens if broader economic pressures force those key customers to pivot, to shift from expansion mode to aggressive cost optimization? How quickly could that optimization focus hit that crucial 120% retention rate, and what would that mean for their growth trajectory?
Definitely a key metric to keep watching closely. Well, that's our deep dive for today. We hope you feel well informed and ready to use this knowledge. Thanks for joining us, and we'll talk to you next time.